If you've ever wondered how to enter the exciting world of the stock market, you're not alone. Many people have heard about stocks and trading, but the concept can seem complex and daunting. In this article, we will break down the basics and guide you through your first steps into the stock market. Understanding the stock market. The stock market is often a mystery to those who haven't delved into it. You might have heard people talk about the market going up or down and how they've made profits or incurred losses. But what exactly is the stock market, and how does it work? Let's start from the very beginning and demystify it. What is the stock market? The stock market is essentially a marketplace where stocks, also known as shares, are bought and sold. These stocks represent ownership in a company. So, when you buy a share in a company, you become a shareholder or a part owner of that company. It's important to note that owning a single share doesn't make you the sole owner of the entire company. The owner of a company is typically the person or group with the majority of shares. For example, Mukesh Ambani, the chairman of Reliance Industries, is often associated with being the owner because he holds a significant number of shares in the company. How companies enter the stock market. Let's illustrate the process with a simple example. Imagine a small sweet shop that has been running successfully for decades. The owner decides to expand and open more stores, requiring a substantial amount of money. To raise this capital, they decide to offer shares of their company to the public. This process is known as an initial public offering (IPO). During an IPO, the company issues shares that can be bought by the public. This allows the company to raise funds from individuals, including retail investors like you and me, high net worth individuals (HNIs), and qualified institutional buyers (KIBs) such as mutual funds and banks. Investing in ETFs and mutual funds. ETFs and mutual funds allow you to invest in a diversified portfolio of stocks, reducing the risk associated with individual stock investments. ETFs are traded on stock exchanges, similar to stocks, while mutual funds are managed by professionals who invest in a variety of assets on your behalf. By starting with passive investments like ETFs or mutual funds, you can gain exposure to a broad range of companies without the need for in-depth stock analysis. This approach offers a lower level of risk and is an excellent way for beginners to get started. To wrap things up, the stock market can be a rewarding place to grow your wealth over time, but it requires knowledge, patience, and a well-thought-out strategy. Before making your first investment, take the time to learn and understand the market. Avoid following tips from unverified sources and consider passive investing through ETFs or mutual funds to get your feet wet. Remember, the stock market is not a get-rich-quick scheme. It's a long-term investment that can help you achieve your financial goals with time and dedication. So, take your first step into the stock market wisely, and you'll be on your way to financial success. Understanding the role of stock exchanges. In India, stock exchanges like the National Stock Exchange (NSE) and the Bombay Stock Exchange (BSE) facilitate the trading of these shares. Once a company's shares are listed on an exchange, they can be bought and sold by investors. The relationship between share price and company earnings. The price of a share is influenced by various factors, but a crucial one is the company's earnings. If a company is consistently profitable and its earnings are growing, it tends to attract more investors, driving up the share price. Conversely, if a company's earnings decline, its share price is likely to follow suit. Why should you invest in the stock market? Now, you might wonder why you should consider investing in the stock market. The stock market offers the potential for your money to grow over time. By investing in well-performing companies, you can benefit from their success and see your wealth grow steadily. However, it's important to remember that stock market investments carry some level of risk. The market can be volatile, and share prices can fluctuate, leading to potential losses. That's why it's crucial to make informed decisions, rather than following the crowd or relying on tips from unverified sources. Beware of unverified advice. In recent times, there has been a rise in unsolicited trading tips and recommendations through SMS and social media, often from unregistered or unreliable sources. It's essential to exercise caution and not fall for such traps. Always verify the credibility of financial advisors and do your research before acting on any investment advice. Your first step: learning and passive investing. If you're new to the stock market, it's essential to start with learning the basics. Avoid the temptation to jump into trading or investing in individual stocks right away. Instead, consider passive investing, which involves buying exchange-traded funds, ETFs, or mutual funds.